Hello everyone. It's Friday, it's January 3rd, and it's the end of the first week of the year, and we're ending it with a bang. Boy, oh boy, oh boy. So for those of you who haven't been following the papers over the last 12 hours, or actually the last 9 hours, U.S. invaded Iran and killed one of their very, very top generals. Now, to give you some understanding of how important this general was equivalent to Osama bin Laden when bin Laden was in charge. All right. So this is a really bad guy. I think we did the right thing by getting rid of him. There's no doubt about that. The world will be a better place. I don't think anybody will miss him, but Russia's not happy. Iran is talking retaliation. Stock markets are, well, let's talk about everything. So as the strike occurred yesterday, I believe around 9 p.m. Eastern time, around that time, and we got news, and right away we saw the S&P futures decline. The Dow Jones was down about 350 points this morning, and we're expecting a pullback. This is the futures contract, and this is in real time, but we're expecting a pullback probably over the next few days down to the 50-day line. Now, for those of you who've been following me, listening to me, watching me, paying attention to anything I've been saying, I've been telling you that the market is grossly overbought and sectors are fragmented and there's very little upside left. And now we're seeing this catalyst. Now, even without this catalyst, even without the Iranian general getting killed, I still believe the market would have pulled back. It would have been just a different catalyst. But overall, the market was way, way, way overdue for a pullback, and I'm expecting a few more down days before the momentum oscillators are back to neutral. If you look at the bond market, this is the futures. Actually, no, this is not the futures market. This is the TLT. But we could see overnight it's up almost a percent, over a point, 1.21. And let's go a little narrower here. As you could see here, remember I told you that bonds look like they're going to be in a tight range, maybe break up a little bit here and then come down? I still believe that. I don't believe bonds are going to see extensive upside unless things get worse, and I don't think things are going to get worse. I'm not seeing anything major developing over this in the short term, which should give bonds enough time to cool off. Also, as you could see, gold is approaching a one-year high. We're not there yet, but keep your eye on this is the GLD. This is the ETF that tracks gold, and it's going to open up also about 1% higher. Gold and bonds have been extremely correlated over the last year, which is why I believe both bond and gold will come down. I don't think they're going to rally. I don't think we're going to see a lot more upside beyond this. So unless there's a major catalyst that happens, I believe we're going to cool off in the next few days, and this gap will more than likely be filled. Now, crude oil. Let's talk about crude oil. Crude oil is making let's look at the one-year high. Crude oil is making a one-year high. Again, a lot of this is, well, not a lot of this. All of this is because of what we're seeing right now with the Middle East. Again, it's hard to say at this point. It's really, really hard to say how much higher crude will go because we don't know what will happen as a result of this. We've been promised retaliation. Retaliation is almost certain. The problem is we don't know how extensive it'll be. Now, if you look at the overnight market, remember I've been telling you markets need to cool off because technology is all the way up here and consumer discretionary is all the way down here, and they should be next to each other. And then utilities are down here next to consumer staples, which is fine, but consumer discretionary and technology are still too far apart. So if you look at yesterday's heat map, this is yesterday's trading session. Notice consumer discretionary, information technology and communication services. I don't know why I can't say this the right way today. Communication services is a subpart of information technology. It's the 11th sector. Why they added it, I have no idea, but they did. They could have just made it technology or information technology, but instead they wanted to confuse us more and make it communication services. But either way, notice they're in line on a daily basis, but they're still out of whack on an average long-term basis. And when you see the technology sector and the consumer discretionary next to each other, that will be a time that the market is even or balanced, because right now it's not balanced. Now, major report coming out today at 2 p.m. is the FOMC. Talk about a wacky Friday, right? We got Iran, we got FOMC. Fridays are usually fairly calm and non-directional, but today we are expecting a little more direction than usually. FOMC, again, I don't think the Fed is going to say anything in the minutes that we don't know. They're going to say that we're not planning on lowering rates, and if economy picks up, we may start raising rates. Either way you look at it, as I mentioned to you before, this is a descending triangle on a weekly basis. On a weekly basis, and we may hover around here, especially with Iran right now, a little bit higher up. With the turmoil, I'm assuming this is not going to be a major catalyst to war, God forbid. But I believe bonds, when this thing cools off, bonds are going to break down. This is a descending triangle on a weekly basis, and if bonds go down, I think gold will weaken as well. But we're not ready for that yet, especially with the turmoil we're seeing in global markets and with the downside we are seeing in the stock market. Let's look at the VIX. This is the volatility. As I told you, I believe it's going to come off 12. It's already trading at 1464. Let me show you something here. Yeah, look for VIX. If we continue seeing, if the S&P closes near the bottom of today, if the Dow Jones drops over 300 points and closes the session lower, there's a good chance we may see VIX hover into the 16, 17 area. And don't be surprised if we hit 20, because I believe the S&P 500 is going to come down to the 50-day line. It is so overdue, it's ridiculous. Look at this. Let me show you something here. I mean, the level of look at this. I mean, this whole period is overbought. We move out of overbought territory here when this little downside happened here. And boom, we move into it within one session. Imagine a rubber band gets stretched out, and then it goes like this and it gets stretched out again. It goes like this and gets stretched out again. It doesn't go anywhere. And that's where the market's at right now. And that's why you're seeing fragmented sectors. Honestly, for the next several weeks, I believe income strategies are going to be the key, especially on the bear call side. So here's where we are. Look, I'm going to level with you. I'm going to be very straight with you. The Fed, they created a massive crisis for income investors. I mean, just look at these numbers. You have a savings account. It's paying like 0.9. It's paying less than 1% a year. I'm just looking here at numbers here. Blue chip average dividend is like 1.7% dividend over 12 months. You can't live on that. I mean, heck, even junk bonds, you're getting less than 5%. And that's junk bonds. That's risky. So unless you've got millions, and I mean millions and millions of dollars, it's going to be impossible for you to generate regular, livable. Key word here is livable income from the market unless you get really creative. And one thing we're good at getting creative. And that's where my friend and fellow trader Rob Booker comes in. He created a really simple strategy that allows any regular Joe or John or Roger or Rob to consistently get income from the market. All right? Consistent, real income without being a millionaire, small account friendly. Livable income, consistent, available for you with simple instruction, and friendly with small accounts. Follow the link below. You really, really don't want to miss this. I'm looking at some dividend yield right now, and it's pathetic. I mean, you can't make money with these rates. So Rob went to a small town in Alabama, and he wanted to prove how it works, and he did. If you guys want to check this out, follow the link below. Honestly, if you want to learn how to create livable, consistent income without being a multimillionaire in hopes of becoming a multimillionaire, follow the link below, and Rob will show you how to do it. Now, by the way, you can make thousands of dollars every Monday morning. It's extremely easy, and if you're not taking advantage of the strategy in your portfolio, you're not maximizing returns. He put together a short video showing how ordinary Americans can generate life-changing returns. And again, if you want to make more than 1.7% dividend for 12 months, or junk bonds at 4. Can you imagine junk bonds paying less than 5%? I can't imagine we're there. Or putting your money in a savings account and making 1% or less a year. Folks, that's not the way to do it. Follow the link below. Learn what Rob's got in store for you. Consistent income, small account. It's easy. Ordinary Americans are going to change how they think about financial markets after they see this. Follow the link below. Check out this video right now and have an amazing weekend. And I'll talk to you soon. Take care, guys.